Hi, my name's John Fazio. Now, if you're watching this video, then you're probably wondering if you are a candidate to do a short pay, meaning that you would pay back the bank some amount that's less than the amount that is owed on your mortgage, but the bank would stamp the mortgage paid in full anyway. So the first question that you might be asking yourself is, why would the bank be willing to take less than the full amount that's owed on the mortgage in order to satisfy the debt and mark it paid in full? And the reason is because the bank has already figured out that if they had to go all the way to the end and they had to take your house back at sheriff's sale, that they're not going to make the full amount that's owed on the mortgage. Is that always the case? No, but for many of you, let's say your house is worth $1 million and you owe $950,000. Well, right off the bat, you've got 6% for closing costs, and then if you have any other debts at all, or anything that would have to come and get paid at closing, then you're clearly not going to be able to pay off the loan in full, even in an arm's length sale. But using that same example, the buyers at a sheriff's sale are only going to pay 65-70%. So the bank's going to lose a couple $100,000 off of what they would make if they got paid over time. When they look at the net present value of the property, when they do a little finance and say, oh, well, what is the money that I'm going to get worth, and what is the stream of money I'd have in the future worth in today's dollars, and they try to figure out if it's a good deal. But in most cases, the big impediment is you. The problem is not that the bank wouldn't do a short pay, because in theory, it's a great option for the bank. They're going to get the use of the capital back. They're going to take a non-performing loan off their books. They're going to get paid all at once, and they don't have any further risk, and they don't have to administer and have all the costs of, making sure the loan modification or other workout goes through. It's great. But can you come up with a lump sum of cash? So the difference between a short sale and a short pay is really what this video comes down to. A short sale is where you actually sell the property, and anybody can really do that as long as there's a buyer that's willing to pay for the property. And usually in those scenarios, you can work something out with the bank, because the bank is posturing that they're going to sell your property out from under you, and now you've gone and done exactly the thing that they're saying they're going to do, but you've done it in an arm's length deal versus doing it in a distressed transaction. The short pay is similar. The same question is present in the short pay, and the same factor is critical to whether or not you can get it done. And that is, what is the most money that someone would be willing to lend you against, or which you would be willing to put forward out of your savings? I don't know why you have these vast savings and investment portfolios if you're not paying your mortgage, but so more often than not, it's not that you have this huge pot of money. It is that you have a lender who is going to play the role of the bigger fool, and they're going to say, oh, I see an opportunity here. I have a high interest rate loan for this person because they're in a pickle and they need to get out of it. And I know they're going to probably refinance with Chase Bank 2 years from now, but I can get a little bit of interest at a higher rate because I know they're motivated to get out of foreclosure. So that's usually the scenario. Is usually you're going to some kind of lender to get some help, and these aren't the friendliest of lenders. They're the ones that are looking to make a buck and make it all at once. So they're going to evaluate, and they're going to do similar thing to like what happens with the discounting in the short sale scenario. The lender's going to say, oh, there's risk here, and you don't have a lot of equity, so we can only give you 70-75%. So you end up paying $700,000 to $750,000 on a $1 million loan in some cases in the short pay scenario, provided that you can get the loan. And that's where the art comes in, is being able to find the lender that would work with you and being able to convince them that you're a good credit risk. So if you have any questions at all about whether a short pay would be right for you or whether you're a good candidate for one, please give us a call at 201-529-8024. We'd be happy to answer all your questions and talk to you about whether a short pay would be right for you. Thanks a lot.